Investment risk refers to the uncertainty that actual investment outcomes may differ from expected results. Every investment involves some degree of risk, and understanding these risks is essential for developing effective investment strategies. Financial planners evaluate risk because it directly affects portfolio performance, wealth accumulation, and the likelihood of achieving financial goals. Risk and return are closely related. Investments with higher expected returns generally involve greater uncertainty and volatility. Effective investment planning seeks to balance risk and return in a manner consistent with a client's objectives, time horizon, liquidity needs, and risk tolerance. Identifying and managing investment risks enables investors to make informed decisions and maintain disciplined long-term investment behavior. Market risk, sometimes called systematic risk, is the risk that investment values will decline due to broad economic, political, or market-related factors affecting the overall financial system. Examples include recessions, inflationary pressures, geopolitical events, changes in interest rates, and shifts in investor sentiment. Because market risk affects nearly all securities simultaneously, it cannot be eliminated through diversification alone. Equity investments are particularly sensitive to market fluctuations, although bonds and other asset classes may also be affected. Financial planners manage market risk through strategic asset allocation, diversification across asset classes, and maintaining portfolios aligned with client objectives. Understanding market risk is fundamental to constructing resilient investment portfolios. Interest rate risk is particularly important for fixed-income investments such as bonds. This risk arises because bond prices generally move inversely to changes in interest rates. When interest rates rise, existing bond prices tend to fall, while declining rates often increase bond values. Longer-term bonds typically experience greater price sensitivity than shorter-term securities. Interest rate changes also influence borrowing costs, economic activity, and asset valuations throughout financial markets. Financial planners evaluate duration, maturity structure, and income needs when incorporating fixed-income investments into client portfolios. Proper management of interest rate risk helps maintain portfolio stability while supporting income generation and capital preservation objectives. Credit risk, inflation risk, liquidity risk, and currency risk represent additional important categories of investment risk. Credit risk refers to the possibility that a borrower will fail to meet contractual obligations, resulting in reduced income or loss of principal. Inflation risk arises when rising prices erode purchasing power and reduce the real value of investment returns. Liquidity risk occurs when investments cannot be sold quickly without significant price concessions. Currency risk affects investments denominated in foreign currencies and results from fluctuations in exchange rates. Financial planners evaluate these risks when selecting investments and developing diversified portfolios that balance return opportunities with appropriate levels of risk exposure. Business risk and company-specific risk are forms of unsystematic risk that affect individual companies rather than the overall market. Business risk may result from management decisions, competitive pressures, operational challenges, regulatory changes, or shifts in consumer demand. Because these risks are unique to particular companies or industries, they can often be reduced through diversification. Holding a broad portfolio of securities decreases the impact of any single company's performance on overall portfolio returns. Financial planners emphasize diversification as a key risk management strategy because it helps reduce exposure to individual security risks while preserving opportunities for long-term growth and portfolio appreciation. Market cycles describe the recurring patterns of expansion and contraction observed in financial markets and economies over time. While the timing and duration of cycles vary, markets generally move through predictable phases influenced by economic conditions, investor behavior, business activity, and monetary policy. Understanding market cycles helps investors maintain realistic expectations and avoid emotional decision-making during periods of market volatility. Financial planners use knowledge of market cycles to develop long-term investment strategies rather than attempting to predict short-term market movements. Recognizing that market fluctuations are a normal part of investing helps clients remain focused on achieving long-term financial objectives despite temporary market disruptions. A typical market cycle includes 4 primary phases: expansion, peak, contraction, and recovery. During expansion, economic activity grows, corporate earnings improve, employment rises, and investor confidence increases. Asset prices generally appreciate during this phase. The peak occurs when growth begins to slow, valuations become elevated, and inflationary pressures may emerge. Contraction, often associated with recessions or market downturns, is characterized by declining economic activity, reduced corporate profits, and lower investor confidence. Recovery follows as economic conditions improve, confidence returns, and markets begin to stabilize. Each phase presents unique opportunities and challenges that influence investment performance and portfolio management decisions. Understanding investment risk and market cycles enables financial planners to build diversified portfolios that support long-term success while managing uncertainty. Different asset classes respond differently to changing economic conditions, making diversification an essential strategy for navigating market fluctuations. Rather than attempting to avoid all risk, effective planning focuses on accepting appropriate levels of risk in pursuit of financial goals. Market cycles demonstrate that periods of volatility and decline are natural components of investing and are often followed by recovery and growth. By understanding various forms of investment risk and the dynamics of market cycles, investors can maintain discipline, avoid emotional reactions, and pursue sustainable wealth accumulation over time.